Hello and welcome to Season 2 of Investing for the Long Term, hosted by Downing Fund Manager Judith Mackenzie and investment consultant Rosemary Banyard. In today's episode, they're joined by Roger Lee, Head of Equity Strategy at Cavendish, who brings nearly 3 decades of experience in the equity markets. Together, they take a deep dive into the outlook for UK equities, discussing current valuations, expectations for interest rates, and the broader macroeconomic story driving markets today. Now, just before we get started, please remember that all opinions and information are for educational purposes and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. Always do your own research and seek financial advice from a regulated financial advisor in your country before making any financial decisions. With that being said, let's get started.
So Roger, I've known of you for a good number of years, very well recognised and acclaimed market commentator and economist. And what I quite like is, I'm going to call it a bias towards UK equities, but I'm sure it's not biased, it's well judged. Your career's not exactly been typical through the years. And I think you described yourself on the Cavendish website as an accountant, physics grad, and a frustrated politician. How did you end up in the position that you are in Cavendish as a market commentator and economist when you've got that kind of background?
That's a great question in a sense, but it all started when I was about 5 or 6 years old, actually, as it happened. And we lived in a little village in Nottinghamshire. We had no sort of real city lineage or any city background at all. And there used to be this village fete in the village every year at the big house. And my mother, who was quite aspirational and came from a very modest background, said to me that the owner of this big house is a merchant banker. And if you want a big house like this, you ought to become a merchant banker as well. And I think from that moment, a career in the city had sort of been set for me. And the rest, as I say to graduates who I interview nowadays, the hard thing is deciding what you want to do. And then once you've decided what you want to do, it's relatively easy to work back to how you get to that point. And so, kind of where it all started. And I was lucky that I'm quite good at maths and became a chartered accountant. And from that was a fairly recognised route into the city. I was a salesman for a long time, a broker for a long time. And it was quite clear that from a personal perspective, and I know you come at markets from a very different perspective than I do, it was quite clear to me that my interest was far more from a top-down perspective of what was driving markets from a very much a macro perspective rather than necessarily what was driving markets from an earnings or a fundamental perspective. So when the opportunity came up, that kind of led into more strategy macro role than individual stock selection and analytical role. So yeah, I'm very fortunate that I don't quite have as big a house as the guy that I saw when I was 5, but I've been terribly fortunate that my career has been my vocation, and I wish everyone could enjoy the same. But yes, that's how it started. Little boy holding his mum's hand.
You did a physics degree, is that right?
That's
Before
correct,
the accountancy. So how does being a physicist inform what you do?
I mean, I think if you look at the stats of the number of grads that are taken on nowadays, I think you'll find, there are more grads taken on by the bulge bracket firms who come from a science background or a maths background than come from an economics background. That wasn't necessarily the case in my day. But one of the strong sciences brings, or engineering or maths, it brings that sort of analytical view. And it's a hard science. It's not a soft science. Now, obviously, what we do is a very soft economics, etc. It's a very soft world. But I think it helps to have come from a background that deals in facts as much as possible and how you relate what you observe, a theory, or the other way around, as Fermi, the famous physicist, said, if an experiment doesn't back up the theory is wrong. And I think it's these sorts of ideas that really help in a city background or financial commentary. It provides a rigor, I think, that some of the more arts-based degrees don't. There ends the commercial for physics degrees.
But that being said, you're known for getting to the point in what you write and making it engaging and interesting. So you're probably doing yourself down a little bit in terms of that scientific bent that you've got. But I need to go back to the last bit of your CV. What's a frustrated politician?
Well, that brings it all together. I tried to get selected twice as a Conservative candidate. I don't know whether I can mention the politics.
Yeah, it's all right. It's after all the by-elections.
I guess I hate using the word passion, but other than markets, I have a significant interest in politics. So it seemed only natural in my 40s that I would try and pursue that. I tried to get selected twice as a Conservative candidate to represent Lincolnshire, which is where I come from. And the Conservative Party saw differently to my own aspiration, and I was unable to even get on the approved list, let alone contest the seats. Not only have I a passion for politics, I'm also the most unsuccessful politician because I didn't even achieve to get onto the Conservative approved list, not once but twice. I think now I kind of view that as a badge of honour and a sign of my integrity as much as anything else. But no disrespect to any politicians that may be listening. But where I think it is really interesting, clearly at the moment, whether you're looking at US politics, whether you're looking at UK or European politics, this conflation between politics and markets, I don't know, Judith, in our careers, I don't think it's ever been stronger. So again, I think I'm quite fortunate that perhaps my background and my interests sort of suit the market that we are seeing in front of us today. I suspect had I been 20 or 30 years older and we'd been having this conversation in the late 90s, I doubt politics, from what I recall, didn't have a particular bearing on markets. I think I can safely say for the first half of my career, I didn't know what the gilt yield was. Now, of course, we know what it is to sort of 2 decimal places. So, and that really, I think, is how things have changed over the last 30 years. But yes, politics now very much a hobby rather than any aspirations to change the world.
You can change the world in different ways, I'm sure.
Comment on the world, perhaps.
Exactly, commenting.
Part of the commentariat, so I can try and comment on the world. And I think that's an interesting, you said, very kind had said about my style and my approach to following markets. And I think this really comes, there is no point knowing something or feeling you know something without being able to share it. And I think how you share your information or your views or your opinions, I think, is critically important in this business. And what I try and do, if there was a sort of a method to this, is that I try and tell stories. And I think that's how we humans understand things best, whether it was a teacher in class or whether, I guess, going back millions of years, it was telling stories by the fire. And I don't see financial markets and or politics as any different to telling stories. And that, I think, is what I try and do, and therefore make markets more approachable and perhaps more understandable. What I find extraordinary is that, whether you're talking to some extremely serious, senior and experienced CIO, the ability to communicate is the beginning, the ability to tell a story. And I think that goes down well, whatever the level of experience the person you're dealing with is.
Yeah, no, very true. Where are your biggest audiences, would you say? I mean, is it asset allocators? Is it hedge funds? Is it, is it macro funds? Or is it people like us who run actually individual equity portfolios?
Well, when I started off, basically, you and Judith and people like you running individual equity portfolios were my audience and my client base. But over the years, that's morphed into, the broader institutional market. So very much asset allocators, that's obviously an important part, the global hedge funds, but probably under index on those, which is just the way the business has evolved rather than anything else. But the private client world, the global asset allocation within the private client world. And the other audience, of course, I think, which increasingly are taking very much an interest in what's going on from a macro or political perspective, is the corporate market. There is a real thirst for boards to particularly try and understand, and we may touch on this later on, why their share price trades where it does. I'm sure we will discuss it, but why their shares underperform when they seem to keep delivering. And I think having someone like me try and put this into a sort of a macro global context, they find it quite valuable. What I do find is the audience for macro commentary is almost endless. Most people, whether it's a CIO or a macro hedge fund manager, to a non-executive director on a board, to an individual, though not necessarily, we deal with a lot of individuals, but maybe more high net worths. They all have an interest in markets because it touches our lives in so many ways. It is the reality of what we live in most people, whether it's through a pension scheme or direct equity investment or shares in their company, have some interest in financial markets. That, I think, is a enduring interest, and fortunate for people like me, because it means that the audience is as broad as it is wide.
One of our frustrations has been that education in schools has not been as good as it should be with regard to money more generally, but also markets. And is that something that you've become involved in over the years, or is it a passion that you share?
I think there's definitely an argument. In fact, as it happens, I recently attended a debate in the House of Lords on that very subject about how to increase awareness in schools. I'm not sure if it has happened. Please correct me if I'm wrong, but I think there was some elements of this were actually being proposed to be included in the national curriculum.
Yeah.
I'm not sure necessarily whether that's happened yet or not. I think it is really important. I mean, if you go back over my life, the number of people doing economics A-levels was relatively small. The early 80s, mid 80s, when I was doing my A-levels. I think the number of people doing economics A-levels at my children's schools probably is the most popular degree. So to an extent, this has already started to happen almost by default, rather than anything necessarily the government has done. I think you're kind of touching on other questions here as well about why the US has a far broader financial equity ownership culture than the UK and Europe. And I think it is changing in the UK. I think it is changing. I've certainly seen it changed over my lifetime, but we've had ebbs and flows in that. If we go back to the late 80s, you'll remember this Tell Sid campaign, the privatization campaigns. Equity ownership was extremely common. And I remember doing a presentation to Mr. Killick, who set up Killick & Co. And he was telling me that in the late 80s, the Killick share shop in Debenhams on Oxford Street was the most profitable piece of real estate within a Debenhams store.
Wow.
These things go in cycles, and certainly back in the late 80s, it was very difficult not to be exposed to the share owning culture, and that has ebbed and flowed a bit.
Yeah, I'm bound to say, my dad first got involved in the 80s because he worked for BT and he got shares in the privatisation. So he had to make a decision, because as an employee, he got quite a good allocation, potentially. So that...
Did very well out?
Yeah, he did, yeah.
Well, the first share I ever owned was I was involved in setting up the investment club at school, and we stagged Reuters. Younger listeners purchased it on the IPO. We stagged Reuters in 1984 and did quite well out of it, I seem to remember. So yes, there was a lot more of an equity culture in the 80s. So again, it's an interesting observation, this, that we didn't need any education. It was just around us in the 80s, and then I think it sort of ebbed and flowed. And I think the regulation hasn't helped. This is a whole separate subject. I know Judith's very keen on this, in that the government regulation and solvency acts, etc., with insurance companies trying to force direct benefit schemes to own more fixed income than equities. So there's been a lot of other factors other than education that I think has changed the equity owning culture in the UK.
You've obviously got experience US global markets, but again, going onto that point, that you're a big supporter of UK markets as well, and that's backed up by data. And I think you worked in Hong Kong at some point as well. But what kind of drew you back to looking at UK equities in particular and coming back to the UK?
It was where the work was. We had a very good few years in Hong Kong, basically selling European and US equities into Asian institutions. And so this was when I was at Deutsche Bank, and this was a very good business for a while. But the European sovereign debt crisis at the time was all engulfing in Europe. Fortunately, we missed most of it, if not all of it, in Asia. The business priorities within Deutsche Bank changed. Selling equities into Europe, into Asian institutions wasn't a core business. Business closed, or they shut the business down, and that kind of prompted a move back to the UK. As it happens, I just happened to move in within UK broking firms that have a specialism in UK equities. From my perspective of how I look at the world, I don't think it necessarily changes things hugely, because you have to look at all equity products through the prism of US equities. It is just possible not to. Whether the specialism just happens to be small cap or mid-cap UK equities, I don't think necessarily changes the story anymore. And in fact, one of the things I find very rewarding is when you're talking to, let's say, an AIM company, one of the smallest, relatively smallest quoted market cap companies in the UK. And I tell them that their share price is trading at a discount because of the largest companies in the world, all of the Mag 7. This is why it is just as satisfying as talking to a global hedge funds. I think it's all part of telling stories and telling narratives and trying to understand what's going on in markets.
Just coming on to that UK case then, so what's your view? Is the UK a fantastic re-rating opportunity, or are these companies just cheap for a reason?
I would like to say they are fantastic re-rating opportunities, and I have to believe that because I just don't accept this sort of zombie UK market. But I am going to caveat this slightly because I think there are some very specific circumstances at the moment which aren't helping the UK equities. We'll just unpack that question a couple of ways, if I may. Undoubtedly, UK equities trade at a discount to their long-term multiple. What we did see leading up to the conflict was we did see that the large cap UK equities were re-rating and actually re-rated prior to the conflict above their long-term multiples. And in fact, the FTSE last year, as you know, was the fourth best performing major equity asset class in the world. It's not a case that the UK will always trade at a discount, will always trade at a discount to its peers. It needed a set of circumstances in order to see that re-rating, and that's what we saw at the end of last year, and that's what we saw at the beginning of this year leading into the conflict. Now, the reason why we saw that re-rating so clearly and arguably a sort of a de-rating in the US, perhaps, because there's two sides of the same coin. What you saw leading up to the conflict and in 2025, you saw a loosening interest rate environment with interest rates generally expected to come down. And in the UK, we were expecting interest rates to come down more than almost any other developed market. And that would certainly be a forecast that we would have concurred with. In fact, we were expecting interest rates in the UK to come down more than perhaps the consensus was expecting. And then if you think about what UK equities are, we are quite a cyclical industry, a cyclical index. We don't have a lot of tech in that. We do have a lot of cyclical companies. And this is particularly true in the mid-cap space. And so as those interest rates start to come down, so equities started to re-rate. That was finally beginning to work. Now, there was another major factor that was driving the re-rating of UK equities, and this was a phenomenon that we saw across the world, ex-US, is the policy volatility that Donald Trump had introduced into the US, particularly around tariffs, but you can almost trace it back to the beginning of his presidency in January 2025. The policy volatility was perhaps causing investors to question this whole idea of US exceptionalism. And then you start to see some beginning to relearn the benefits of diversification. And you start to see that in the fund flow data coming back out of the US into almost any non-US asset of which the UK would benefit. And then you started to see some sort of questions over AI and AI profitability and monetization. And that accelerated this trend away from the US. Now, not necessarily a massive trend away from the US, but just a relearning of the benefits of diversification. So that was all setting up nicely. The combination of maybe questioning US exceptionism and why you would only own US equities, and also an interest rate story in the UK, will set us up very nicely. And of course, then the conflict changed everything. The oil price went up to $120 a barrel. Inflation expectations in the UK just diametrically changed. So instead of expecting 2 rate cuts, the market was then expecting 2 rate rises. And so all of a sudden, all of the benefits of cyclicality became a hindrance to UK equities. And that's, I think, simply what we've seen over the last few weeks, up until maybe the last 10 days or so since the peace deal was announced and the oil price started to fall. So it's a bit of a nuanced story. I have to believe that value will come out eventually. UK assets and mid-cap assets generally across the world trade at fairly significant discounts to global equities. Obviously, global equities, in this context, we talk about some of the largest equities in the world, which are in the US. And that discount will eventually close. And if we don't close it as institutional fund managers, then private equity and strategic buyers will close it for us. And that's what we're seeing, what we've even seen today. And that's going to be a loss to the UK. It's going to be a loss to our unit holders and our pensioners. That is the sad reality of what we're facing. The discount that UK equities trade on is such that companies, strategic buyers, are able to pay a typical M&A premium, and still buy that asset at a discount to its long-term valuation multiples. And this is what we're seeing over and over again in the UK, and we're seeing it elsewhere in the world. It's a shame, but to me, it gives me comfort that at some point that valuation gap will be closed.
What would you do to improve the landscape for the UK stock market so that more companies listed here and less disappeared?
That is a very complicated question, I think, because fundamentally, from a personal perspective, I would disagree with regulation and, generally speaking, government interference, because that tends to lead to outcomes that you don't necessarily want. I think, to be fair, the government have recognised the problem, and the stock exchange have recognised the problem. So they are trying to improve the attractiveness of the UK, and I think that is to be commended. There is no doubt that when good companies do list, we can find demand for those. And certainly leading up to the conflict, certainly from our own business's perspective, we were seeing inquiry levels at reasonably high levels. I think the market backdrop was working in our favour. There's clearly a political will to improve this. But at the end of the day, we cannot control the oil price, and that has clearly introduced a level of uncertainty into the UK that has put off some potential listings, at least in the short term. Specifically to answer your question, what can we do? I think the government has to create an environment that is business friendly. The government has to create an environment that businesses and entrepreneurs want to list and live in the UK. That perhaps leads on to broader questions, but I think regulating pensions or telling pensions to invest a certain amount of money in the UK assets, I'm not sure it's necessarily the right way of doing it. I think prescription rarely works. The only suggestion I would make, and again, I stress this is a purely personal view, not the view. We do have a very attractive savings wrapper in the UK in terms of the ICE. Clearly, a family with 2 children, if they have the resources, can invest a very significant amount of money tax-free. That benefit is paid for by the general tax-paying population of the UK. So it seems to me perverse that you can then take that tax benefit and invest in the S&P.
Yeah.
It would seem to me very obvious that if you are giving someone a benefit from the UK taxpayer, that money should be recycled back into the UK, into UK indices. So that perhaps is the only prescriptive element I would adopt, because philosophically, it seems that the UK taxpayer is not getting great value for money out of that tax break.
Yeah, I think that's very fair. What do you think is the single most important fact about the UK market as it stands today that maybe gets overlooked?
I'd have to say valuation. Just everything in my world comes back to that, as it does in your world. It comes back to valuation. Your listeners don't need me to tell you that the UK equity market is cheap, because lots of people say that. It's demonstrable with the amount of M&A activity that the UK equity market is cheap. The overriding most powerful factor for the UK is relative valuation. I certainly don't discount the importance of falling interest rates in terms of helping that valuation gap close.
So at the time this is being recorded, we've just had our Prime Minister resign and a new candidate appear with great excitement in many places. How much difference do you feel that an individual can make in the situation we find ourselves in this country? Or is just the level of borrowings that we've got just simply too high and pushes us in certain directions?
First part of your question, none, will make no difference at all unless there is a change of policy, change of economic policy. There is very little or no evidence to suggest that will be the case. So let's just step back a second, because I just wanted to tie in what we were just talking about before about valuation and UK equities. And I think I said a few minutes ago that, I have no doubt that valuation gap will close at some point. There is also no doubt that part of that valuation gap in the UK is driven by political uncertainty. I'm not making a political point here at all. I'm just merely observing that UK government borrowing costs are the highest in the G7. Clearly, the bond market, international investors who lend the UK government money are demanding a higher return than they are of Italy or other countries that would perhaps be seen to not have the most robust of creditworthiness. And there is one of the contributory factors to why UK assets trade at a discount. One, not all of it, but just one, is that we do have elevated gilt yields, financing costs for the UK government, and that undoubtedly is weighing on the valuation of UK assets. And I see this fairly regularly, actually. You talked about, my client base and the world I speak to. I am fortunate enough, I speak to quite a number of European investors. And again, they come back to me with a very similar story. Yes, we see that the UK assets are cheap, particularly mid-cap equities are cheap. But we do not want to take the political risk. If you're investing in Portugal or coming from Portugal or Italy or Germany, you are well aware of what political risk does to equities, because they all live through the European sovereign debt crisis that I've referred to earlier. And they look at the UK, and I think good reason, they see that there is political risk here. And that then leads on to, well, why is there a political risk? And it really comes back to the UK deficit and the level of borrowing and the lack of growth to repay that. And so this is all part of that same narrative, that at the end of the day, you need consistent government that will deliver a growth environment which will help companies perform, and that will attract new investment. As we stand at the moment, and this isn't just a Labour issue, the Conservative Party suffered from the same. We have found it in the UK very difficult to generate that growth. We found it very difficult to generate the growth that's required to meet the spending commitments that successive governments have adopted. And so we have ended up where we are. This is a challenge that not only the UK is facing, but also, other Northern European countries are facing. And unless there is a clear change or a clearer understanding of how economies grow, then I don't see how an individual, even if he is more popular, more likable, more personable, can necessarily change it. This, in many respects, to generate growth in an economy is relatively straightforward. You need low regulation, low tax burden, and low energy prices. And this comes from Adam Smith. This isn't necessarily nothing new about that at all. It is widely accepted that you need those three fundamental economic planks in place. And, there are lots of subsets of each of those and all the rest of it. You can talk about low regulation is important because it allows companies to grow. It provides less of a hindrance for them. That was very clearly sort of supply side economics of Milton Friedman and what Thatcher and Reagan introduced in the 1980s. You can talk about lower taxation. Well, that starts to address issues around welfare bill, welfareism, etc. And of course, lower energy costs is a choice centered around net zero. So if you accept that you need those three overriding economic forces of low regulation, low tax burden, and low energy prices, if you are doing the complete opposite, then why is anyone surprised that you live in a low growth environment? And this is what I find very frustrating, is if these are economic truisms to an extent that there is anything true in economics. And it goes back to my physics background. If you keep doing the same thing and expecting that different outcome, then the experiment does not meet the theory. And that's why and it's not just the UK, that's why Northern Europe is struggling with this very low growth environment. And so again, a bit sort of long-winded way of answering your question. Unless there is going to be a fundamental reversal of those three, we are merely just tinkering around the edges, and it's I think it's style over substance.
You might just send this episode into Treasury and see if anyone pays any attention.
I don't think they would be surprised to hear talking about this. You don't need to believe me or believe other economists and strategists. You have to look at what's happening in the United States. Generally speaking, the US outperforms because it has those three elements. It has very cheap energy prices. It has a relatively low tax burden and does have a low regulation. It has a lower regulatory threshold than we do in the UK. And that's just the reality of what we are faced with. Will it change? A lot of what we are seeing now, I don't want to go too far into the 1970s, but a lot of what we are seeing now is a sort of a repeat of some of the features that we saw in the 1970s when I was a child, and getting a bit more sort of financially aware. And I do know that it can change, and it can change very much for the positive. But I can't really see any evidence at the moment that there is a political leader out there. I have to say, Banyard came out with some interesting comments at her city forum last week, but I'm not totally convinced that certainly anyone in government is starting to acknowledge that some of these key fundamental drivers to growth need to be in place before we actually see growth.
It's very easy to talk ourselves into a doom loop, isn't it? And
Well, I don't want to be too negative about this because economies are remarkably resilient and companies are remarkably. But it was merely specifically to answer your question: will anything change?
Yeah.
With the new incumbent in number 10. And so maybe there will be some change. There is no question that one of the great myths of Mrs. Thatcher was that she introduced supply-side economics. In fact, that is not the case. It was introduced by Callaghan and Dennis Healy in response to the IMF intervention in the UK. So a lot of what she was doing was an extension of what was in place, introduced by a Labour government. So it's not impossible, but I don't see any evidence of it. And in fact, what I find quite concerning is that, let's give a couple of real examples to your audience. I mean, a couple of real examples. I could forecast that if you increase the national living wage for young people by increasing the costs of employing young people, then there will only be one response, is that we will employ less young people. And, I cannot believe that was their intention, and yet that is the reality, and it was extremely forecastable. I mean, 16% youth unemployment, young male unemployment is cut to 20%. I mean, these numbers. I mean, this isn't just an economic stat. It's the sad reality of the UK, and that cannot be a good thing in any sense of the word. I'll give you another example. Here's a very simple one. If you increased, and the Conservatives for this one were just as guilty. In fact, they were just as guilty on the national living wage as the Labour Party was. So clear, these are partisan points. I mean, this is an extension of what we've seen over the recent past. But you take landlord reform. If you introduce more regulation for landlords, if you increase the cost of renting homes out by a landlord, if you reduce the profitability of renting a home out by a landlord by increasing the tax burden on landlords, what do you expect to happen? Do you expect there to be more properties rented out or less? Less. It's obvious. And, again, you don't need a physics background or economics background to work out where this ends up. You end up with less rental properties, and therefore what happens to rents? They go up, which is completely contradictory to what the intention of successive governments were. From an economic perspective, it's quite frustrating because you can see these things playing out in real time.
Slow motion, actually, as well.
Yes, yeah. We can see the car crash coming, and you kind of know what the outcome is, but yeah, it's quite painful.
And so we end up where we are. But again, absolutely, to be clear, this isn't necessarily a UK phenomenon. It's been a phenomenon probably certainly across European markets now for quite a few years. We are not the only country in Europe that has very high energy prices,
So the title of this podcast is Investing for the Long Term, and both Rosemary and I are long-term investors, but it's quite easy to feel a little bit paralysed sometimes, given some of the macro backdrop that you've talked about. Give our audience one bit of advice. What would it be?
If you genuinely believe in the long term, and I think this is always the problem, you have to believe that valuation will always come out. You have to believe that. I think we've been talking about, specifically in the context of UK equities over the last couple of years, is that corporates and strategic buyers recognise that value. Eventually, that value will be recognised more broadly. And I think you have to believe that the valuation will come out, and it does eventually. And we have this expression, as both of you know, that stocks rise to a buying level. And, at times it looks as if stocks will never, ever pick up. They will never reflect their true value. And I always take great comfort looking at the UK bank sector for years after the financial crisis. Successive bank analysts would tell me, the UK banks are trading at half book or whatever they were trading at. And investors would say, well, they will never re-rate because of X, Y, Z structural reasons. What's the view? And of course now the UK banks have re-rated back up to, broadly speaking, European peers, maybe not quite as much as the US banks, but different kind of makeup and different regulatory backgrounds, etc. But so it can happen, and it does happen, and it will happen, and it just takes time. Now, I would again want to stress a positive, just to conclude, is that we have over the very recent past as in over the last few weeks, the conflict, we have had this interest rate environment that was suggesting at one point there would be 3 interest rate rises. Now, that is not good for UK domestic, and that's not good for a kind of UK PLC. We very much believe that the oil price will normalise, as we are sort of seeing at the moment, if the peace holds and the Strait of Hormuz, which we're now so familiar with, returns back to some sort of normality. We think the oil price will normalise rather quicker than the market's anticipating. And that's really based on, not that we follow shipping traffic through the Strait or anything detailed like that, but basically what happened in 1991 and after the first Gulf War. And then the oil price, broadly speaking, went back to where it was pre-conflict very quickly after the liberation of Kuwait. Not because supply had normalized, not because all the energy plants were fully working again. And in fact, if you recall, that Saddam had set fire to almost every single oil well in Kuwait, but because the market was anticipating a normalization, and that's what's important. Secondly, it does look, again, people may have forgotten this within the in the noise of the conflict, that the UAE have pulled out of OPEC, and that is also important because, again, going back to my childhood, we've lived with OPEC controlling oil prices for virtually the last 60 years, and OPEC now looks to be not remotely the force it was. So we're already starting to see, or people are already starting to talk about the idea that the market will be in oversupply post-conflict if it holds. Very important, conditional. And in fact, it's not unreasonable to assume that if we take a combination of 1991 and what, say, happened between 2014 and 2016, when the market was seeing an oversupply of crude oil, that the oil price could fall quite materially. Now, if that happened, then the inflationary impulse that the market was so concerned about during the conflict reverses to a deflationary impulse. That is just the maths. That's how the arithmetic works. That would require a very different Bank of England response. And so if we started to see, as we are doing right now, interest rate expectations falling in the UK, the UK still, in fact, is the only developed economy where there is a significant scope for interest rate cuts. Eurozone rates are 2.25%. They just put up rates by 0.25 point 2 weeks ago. The US, the new Fed governor of the US, is clear as you possibly can be that rate cuts are off the agenda for the time being, which is a different subject. So the UK, amongst those developed market, offers the most scope to cutting interest rates, and that is a very positive for UK domestic stocks. And we've already started to see this over the last 10 days or so. If we can disaggregate some of the political risk, if we start to see the oil price falling, if we start to see interest rate expectations coming down, then that is a very positive backdrop to seeing some of this re-rating.
I think that's really helpful because I often get asked what the catalyst is, and you just articulated it there.
Again, this is why I do my job and you guys do yours, because I look at this from a very top-down perspective, and the correlation between the FTSE 250 mid-cap equities in the UK and interest rate expectations is very high, and particularly very high amongst certain sectors, as you would expect, way more than you would ever really anticipate in a real-world environment. As much as there are economic truisms, we've touched on this a couple of times, or market truisms, I think the interest rate expectations falling in the UK is probably the single most important fact that determines the performance of UK equities and UK PLC. And I hope that I've shared at least some thoughts about why those interest rate expectations should come down fairly quickly. And I would also add that a lower interest rate environment, notwithstanding all of the sort of fundamental concerns one has about government policy and government choices, lower interest rates, generally speaking, would help growth as well. It would be the single most important missing piece for the UK at the moment.
As we draw to a close, ask our guests if they can recommend a book or a podcast that you're enjoying.
Yes, I would urge everyone to listen to The Rest is History and Dominic Sandbrook's podcast for the 1970s. And you can then draw your own conclusions over where you think there are similarities and where you think there are differences between what we are experiencing now. I think Dominic Sandbrook is one of the great modern historians or great commentators of modern history, and I think that's I think his series of the 1970s gave a very clear understanding of perhaps some of the issues that were being faced then and what we're facing now. So I would definitely urge that. Yes, in terms of a book at the moment, I'm reading a great spy thriller about Moscow and Russia and what's going on there, David McCloskey. But I think that's more for escapism rather than...
We like escapism as well. What is it? What's the name of it?
David McCloskey. Oh, I just forget the name of it now, actually, on the top of my head.
We'll find it.
But that is purely escapism. I could think of something more highfalutin.
That's a great combination. Rest is history and some...
For perhaps pure escapism, maybe something like David McCloskey, which is a great spy thriller, and Moscow X. And I think that's... he also did one about Damascus and Syria, which was a bit more disturbing. But yeah, combination.
Great. Roger, thank you. That's been reassuring, educational, and just as you said, you're a fantastic storyteller, but you do it with economics, so thank you.
Well, that's it for today. Thanks for listening. And in our next episode, Judith and Rosemary will introduce you to another key person from their extensive network from across the investment sphere. If you liked what you heard, please subscribe and leave a comment. And to learn more about Judith, Rosemary and Downing, please visit www.downingfundmanagers.co.uk. All the links are just below in the show notes. Thanks for listening, and we look forward to speaking to you in our next episode.